Hello everyone and welcome back. In this video I want to make an update of my portfolio, how I'm positioning the portfolio to outperform the market in 2026. So I want to go through each of the holdings I have in my portfolio and tell you the case, why I am invested in this company in terms of valuation, growth rates, potential catalysts, and what I want to do for 2026. The things I want to sell, the things I want to buy, all these things at the same video, so I will navigate through different websites maybe or show you different metrics so you can really understand how I'm creating this portfolio that is pretty concentrated actually. The portfolio right now has 12 stocks that I know quite well, that I think have a lot of potential in the future. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And the goal with this YouTube channel is to help you become a better investor, improve the performance. And now with the portfolio I have, I think I can make 20-ish% per year, something like this. Depends on the valuation. If valuations I have go up massively, or valuations go down immensely, anything can happen in this market. But the goal and how I want to position myself for 2026 is 1, to avoid the traps. 2, to avoid low quality companies. 3, to benefit from AI and not be disrupted by AI. 4, to increase earnings per share for all these companies. I want to be invested in companies with a growth in earnings per share. If you are not growing your earnings per share, not interested. In 2024, so 2 years ago, I had some value plays in my portfolio. And in 2025, I went back to my roots of only investing in quality companies. So in the past, maybe 20-30% of the portfolio was comprised of value plays. Now it is no longer the case. The first position I have in my portfolio is Brookfield. That's roughly 14% of the portfolio. If you go through Brookfield, it's an alternative asset manager that is too complex for most people because you have many adjustments to make. If somebody goes to Guru Focus or Fiscal AI or Stock Unlock or any financial website, they will not understand, and that's okay. Brookfield is not a company for everybody. If you look at the revenue line, you are talking about a revenue that goes up and then goes down. If you look at the net income, it's a mess. If you look at the free cash flow, it's a mess, and that's where most people would stop the analysis, and that's perfectly fine because I have a master's degree in accounting. I've been to business schools and I've worked in the asset management industry. I know how this industry works, and I know the kind of adjustments you want to make to really understand business models in the asset management industry. So most people would stop the analysis here, but that's fine. I think I have an edge. So I think I can understand all the adjustments and I'm buying. Okay? Right now, I am holding a strong conviction in Brookfield because I've done the work, I've done the research, and I think what is important for Brookfield is not the real free cash flow. You have many adjustments to make when it comes to carry or distributable earnings, a lot of debt, but actually that's debt that is not real debt. You have many adjustments to make. And what is really important if somebody wants to go deeper for Brookfield is to look at 1, the distributable earnings, most important metric that you have to adjust. 2, the guidance and the credibility of the track record of the management team. 3, the kind of assets they have. Do they have a lot of problems, a lot of risk when it comes to their balance sheet and their debt? 4, the real estate part of Brookfield. Will it carry a lot of debt, a lot of problems, or not? If you can figure out these 4 things, you can be a proper shareholder. Okay, but I don't want to make a complete video on Brookfield. I think it will be pretty interesting to a lot of people. but there is one YouTuber that does it even better, called Daniel Pronk. So I'm only discussing Brookfield with people inside my coaching program. I don't think for YouTube videos it will be too beneficial because Daniel Pronk is doing all the work here. Okay, so please watch his channel if you want to know more about Brookfield. I don't plan to make videos on Brookfield. It's technical and Daniel is doing a wonderful job already. But yeah, if you can figure out how the distributable earnings are working, the growth rates, the assets, the balance sheet, maybe you will understand Brookfield. And maybe it will fit inside your circle of competence. I think now Brookfield is at fair value, maybe a little bit cheap. The guidance is they plan to grow distributable earnings by 20-25% per year for the next 5 years. Every time the management issued guidance, they always delivered. They have always underpromised and overdelivered for the past 30 years. And now the current guidance is they plan to grow at 20% for the next 5 years. And if you think distributable earnings are an equivalent of the free cash flow, the company is roughly trading at a price to free cash flow of 17. So you have something that can grow at 20% per year. They have always delivered their guidance. Price to free cash flow of 17. I'm taking the investment all day long. And right now the stock is dropping. The stock is not doing anything actually. Dropping a little bit because you have some debt linked to software companies. But I don't see this as a key issue. I think you have one of the best capital allocators in the world, Bruce Flatt, with a clear vision and a clear reacceleration. And if AI rules over the world, if you have more infrastructure, more data centers, Brookfield will benefit. If you have more energy deals, Brookfield will benefit. If we live in a world driven by AI, Brookfield will benefit. So actually, Brookfield is my favorite infrastructure play and maybe AI play. It's not sexy, it's hidden, it's hard to understand, but I love it because I know very few people will follow me into this investment. Brookfield is misunderstood by many, and if you want to do the research, you will maybe find some people looking at the sum of the part analysis. I strongly disagree on sum of the part valuations. I don't think this is helpful at all to value this on a sum of the part way at all. Okay, just simplify your valuation metric. A valuation based on distributable earnings will do the work. But good luck if you want to do the research. Not everybody can do it. If you can, wonderful to you. You can look at all the adjustments. If you cannot, it's okay. I mean, it's a very hard business to invest in if you're not familiar with the industry. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. The second business I have is Google. Well, we are talking about already 2 AI investments that will benefit if AI rules over the world. Brookfield is expected to grow at 20% per year because the earnings are growing 20% per year. Google is expected to rule over the world. And actually, I have trimmed Google because the stock has gone up too much. I'm vastly in the positive territory for Google. I bought the dip and I'm still bullish on the company. I think the valuation right now is a little bit high. The capex is a little bit high. So the more I look at it, the more negative I become, because Google was a wonderful investment a couple of months ago. And a wonderful company can be a bad investment when the valuation is too high. What is too high a valuation for Google? Be my guest. Some people may argue a PE ratio of 30 is too high. PE ratio of 40 is too high. PE ratio of 50 is too high. And nobody has the right answer. That's why you manage your own portfolio. Somebody else will manage their own portfolio. The convictions are not the same. I think I will still hold Google maybe trim a little bit if we go higher and higher and higher, because the optimism is kind of crazy with Google right now. If you say publicly that you want to change the allocation of your portfolio because of risk management and you want to trim Google, people almost insult you. So to some extent, people become delusional only because the stock has gone up. If you want to have some fun, you can go back in 2025 and go back to what people said on comment section on YouTube when the stock was going down, that Google would be disrupted. And if you make a bullish assumption on Google, you would get insulted. So it's quite funny that in less than 1 year, the mood has completely pivoted, completely changed. In the past, when you were bullish, people would get very angry at you. And now if you are bearish, people are very angry at you. As always, people are emotional. And as always, as long-term investors, this is our edge. Because we are cold-blooded investors, rational investors. We don't make stupid decisions based on emotions. So yeah, as always, rational investors will succeed and will thrive in this market. People are glued to their screen too much. People think with too many emotions. We have a new wave of new investors that have not suffered enough with the bear markets or flash corrections like we've had in the past. So yeah, it will be very interesting to follow Google. I don't plan to sell completely the position, but the more I look at it, the more I look at the capex level, the more hesitant I am. Not because Google is a bad business model, but because I am seeing better risk-reward opportunities. With the same growth prospects, I can buy things at a discount, at a cheaper valuation. Okay? Third biggest position I have, it's Mastercard, a position that has been built recently. I had the opportunity to buy Mastercard at the lowest valuation we've had in a while. The business right now is growing earnings per share at 20-25% per year. And we are talking about an asset-light business model with the zero capex, and they are doing buybacks every year with zero signs of disruption from AI. We talk about a golden scenario, 10 out of 10 opportunity. I could not be more proud of my latest buy for Mastercard. The valuation is fair value. The business is exemplary. I'm a happy holder. I think right now Mastercard can generate 15-20% per year for the next 5 years. So it will not make me 25% per year, but it's a defensive play with a very appealing risk-reward opportunity. So I bought the dip in different tranches, and the timing of the buys were pretty good actually. So yeah, really looking forward to seeing how it goes. On a 1 year performance, the stock is flat. On a 3 year performance, the stock is up 50%. I think we have a situation where the stock went nowhere for a couple of months, more than 1 year, but the fundamentals improved. So valuation got way better, and I'm very happy to hold Mastercard in the long term. Another company that is similar is MSCI. MSCI is a company that I like because they are focused on the shareholders. They are doing massive buyback programs, and they are very asset light, huge margins. The founder is still the CEO. We are talking about a double-digit grower, and they are accelerating the pace of buybacks. They generate a lot of free cash flow, and they have a huge moat. Very happy buyer of MSCI. The valuation is fair value. I covered the earnings on my channel. The stock went up the day of the earnings for some reasons, and now the stock went down for some reasons. AI disruption. Anyway, I think the business will be extremely fine in the long term. Next one on the list, one of the companies I am most bullish on for 2026, it's Fortinet. So Fortinet is a company in the cybersecurity industry. One of the few companies that is profitable, and now the company is being doubted by Wall Street. Wall Street thinks the company will grow not much, and a couple of days ago they reported earnings. Guess what? They grew more than expected. Guess what? They guided for more growth for this year. Guess what? They are having more billings right now. So as I said before, Wall Street is wrong. Wall Street is too pessimistic. And now, I just saw a report today. Wall Street is increasing their guidance for Fortinet because, surprisingly, Fortinet is not dead. I told you a couple of months ago what would happen for Fortinet, and it seems like this is exactly what is happening. So I'm extremely confident in Fortinet. I think we are right now in a amazing buying opportunity for Fortinet. Amazing buying opportunity for Fortinet. And if you look at the forward PE ratio, forward price to free cash flow, I think that's still too conservative. Wall Street is not bullish enough on cybersecurity companies, and especially Fortinet. Fortinet is very conservative for their guidance. I think they will beat revenue guidance. They will beat earnings per share guidance for 2026. And I hope this video will age well, because Fortinet is a big position for me. That's 10% of my portfolio, but I'm extremely bullish for Fortinet. The founders are still here. The company is focused on efficiency. They are enjoying pricing power. They can increase their prices. They are in an industry that is growing double digits, and they are doing massive buybacks. They did massive buybacks in 2025. They are doing massive buybacks in 2026. They recently increased their buyback program. I'm extremely bullish for Fortinet, and I want to buy more. I hope there is a crash, actually, in the cybersecurity department. Fortinet goes down immensely, and I can double down the position. I am so bullish on Fortinet, I could make it a huge position from 10% of my portfolio to 15-20% of my portfolio. This is the kind of conviction I have with Fortinet. I'm extremely bullish, and I've been covering the stock for many years now, so I know quite well how conservative the management can be and how hard they are working. Fortinet is known for having many bugs at the same time. I think people don't know how to analyze Fortinet. Fortinet is misunderstood right now, and I would not be surprised if Fortinet is back to all-time highs in a few years, and people say, oh, look at this crazy buying opportunity we had in 2026. It was so self-evident, self-explanatory that we should have bought the dip. I'm seeing this scenario in front of my face. So I bought the dip, actually. I bought the dip when it was trading at 75, and I bought again here is 75. I'm extremely bullish for Fortinet. Please, investing gods, make the stock price go down so I can increase the position massively. This is all I can wish for 2026. A massive crash, and I can double my position. I've seen no compelling arguments for being bearish. I know all the bearish arguments. By the way, good quick tip for you. If you want to be bullish on a stock, please know all the bearish arguments before, so you will not be surprised. I know all the bearish arguments, and I still want to buy more Fortinet. That tells you everything you need to know, right? Next one on the list, you have Meta Platforms, one of the key beneficiaries from AI, one of the best CEOs on earth. Great company, great valuation. They are guiding for 30% growth rate. Things are fine. They are re-accelerating capex, but the revenue is re-accelerating, so it makes sense, more sense for Meta Platforms compared to Google. Next one on the list, this is a little bit more speculative. You have Adobe. I bought Adobe and I doubled down, tripled down on Adobe, and I'm down, but that's fine. That's only short term. People are panicking too much over Adobe. It's a little bit too early to judge whether they will win or not AI, but I think the risk-reward ratio is pretty appealing here. If Adobe is dead because of AI, it's okay. Maybe the stock will get cut in half, I lose 50%, or maybe it goes bankrupt. Unlikely, but maybe it goes bankrupt, I lose 10% of my portfolio, that's it. But if I'm right, oh boy, I make 25% per year. So yes, it's a very appealing risk-reward opportunity. If I'm wrong, so be it. If I'm right, I make 25% per year. Or even more if there is a re-rating. So right now the company officially is very confident in their strategy. They are doing massive buybacks. They say we are cheap, AI will help us. But for the moment, Wall Street doesn't believe them. I'm happy to bet against Wall Street. This is not the first time I'm doing this successfully, and this will not be the last time. So I'm betting against Wall Street. Maybe I'm right, maybe I'm wrong. I'm not 100% certain, but this is the life of investing. You're never 100% certain. You can be 70% certain, 80% certain, and you make a decision. Some people will hate Adobe, that's fine. Some people will love Adobe, that's fine. I remember how sentiment can change. Now the stock is down, so people cry like children. If or when the stock goes back up, people will say how easy it was to buy the dip. It's always the same. So I'm not worried at all. This is not the first falling knife I'm buying. I bought Meta Platforms when it was crashing in 2022, so I know how it works. So we'll see how Adobe plays out. Maybe 2026 will be a bloodbath, but now we are almost getting at a stupidly cheap valuation. Forward PE ratio of 11. The stock is expected to die soon, but so far I am not seeing any signs of death. So far I'm seeing deceleration, but they can monetize AI very easily. So we'll see. Some say it's I received a comment today, Adobe is the blockbuster, similarly to Canvas and Figma are like Netflix. Fair enough. Next one on the list, you have Autozone. Autozone is actually a defensive play that I like to have, but I would not hesitate to trim if I find something else, because the stock is impossible to kill. The company is impossible to kill. The reports are extremely boring. Nothing ever happens for this company. They just generate free cash flow, and they use all this free cash flow to buy back shares. That's it. End of the business. They are growing a little bit every year, and now the stock is a little bit expensive. So maybe if I find better risk-reward opportunities, I will trim. But so far, the company is in a very good shape. After this, you have a Lam Research, something that I have trimmed recently because of valuation concerns. We are talking about a company in the semiconductor industry that is benefiting a lot from AI, that is reaccelerating a lot thanks to AI. And now you have the highest valuation ever for Lam Research. Historically speaking, the PE ratio is 20. I bought at a PE ratio of roughly 20 actually. Now the PE ratio is 47. Extremely high valuation. People think Lam Research will grow to infinity, that AI will grow to infinity. This is priced to perfection. So I already trimmed the position. I will not hesitate to trim more if the stock becomes crazy. I would love to see Lam Research going up. I sell Lam Research. Fortinet going down. I buy Fortinet. This will be an extremely good scenario for me actually. Next on the list you have Landbridge, and now we go to smaller positions, only 5% of the portfolio. Landbridge is maybe the most misunderstood company I have in my portfolio because the company is young, you have many adjustments to make, and the stock is moving a lot. So people are getting emotional. When the stock is going up, people are celebrating too early. When the stock is going down, people are too pessimistic. But it's fine. It's the only IPO I have bought. It's a very young company, similar to TPL, Texas Pacific Land. But I've been a shareholder of TPL between 2020 and 2024, so 4 or 5 years of ownership. I know how this business model works. This is why I bought this IPO, this young company, because I understand the business model quite well and I know it works, I know it's profitable. It's a company that operates in the water segment in Texas. It's a royalty business model, extremely high margins, zero capex, and if it turns out you can have data centers in the Permian Basin, Landbridge will go 10x, 20x. It will be a huge multi-bagger. So in terms of risk reward, I think it's pretty appealing, but it's only 5% of my portfolio. It's speculative, guys. I'm not expecting the moon for Landbridge. I don't want to make it a core position, 10% of a portfolio. No. I know it's speculative, and if I lose everything, so be it. But I think if I lose 5%. If I'm right, oh, that will be spectacular. Spectacular. If I'm right and they have a strategy to welcome data centers in their lands, it's an investment for the next 20 years. That will be extremely profitable for shareholders. But at the same time, Landbridge has many problems when it comes to the incentives of management. You have WaterBridge, but also Landbridge, WaterBridge, PowerBridge. You have the same CEO for two companies, WaterBridge and Landbridge. It's a spin-off, it's a young IPO, they have the land structure, and then you have PowerBridge, somebody from Talent Energy that is the CEO. It's very complex structure, so Landbridge is not for everybody. Please be extremely careful if you want to invest in Landbridge and consider it as a speculative play. Don't make Landbridge a core position if you don't know what you're doing. If you know what you're doing, do whatever you want. If you don't know what you're doing and you're hesitating, Landbridge is not for you. I'm telling you, people will be very disappointed if Landbridge doesn't deliver. You have to know the risks in advance, okay? Next, in my portfolio, Amazon. That's 3% of my portfolio and I want to sell it. I'm not happy. And I think I can find better. I know I can find better. And AMR, which is also speculative, 2%. We are talking about a coal play, metallurgical coal play. It's maybe the only value play I have in my portfolio. The risk-reward ratio is extremely appealing. So it's only 2% of my portfolio. It will not move the needle. So this is it. So yeah, this is the portfolio I have right now. You can see that the quality of the portfolio has increased compared to 2025, compared to 2024. Many of these companies are asset light. Most of these companies have zero capex. Most of these companies are doing buybacks. Most of these companies have very high margins, are very profitable, and most of these companies will benefit from AI. Some of them are being doubted right now. Sometimes Wall Street is negative and pessimistic. I am very happy to take the other side of the bet and make huge positions when I think something is inside my circle of competence and the valuation is appealing enough. I think this portfolio is very well positioned to outperform the market in 2026 and beyond, like to make 15, 20, 25% per year. And actually, you can clone my portfolio because as you can see here, my portfolio is public on eToro. You have a link in the description of this video and all of my videos to access my profile, and you can clone my portfolio, copy trading of my portfolio. You have already 360 people that are cloning my portfolio in real time. I have 10,000 followers over there. So you can actually invest as if I managed your money, but you clone my portfolio. You will have exactly the same performance. If I buy something, you buy something, the same second. If I sell something, you sell something in the same time, in the same amount. So if you want the same performance I have, the same portfolio I have, you can create your eToro account and clone my portfolio. It's free. You have zero fees. And maybe it will be available on your country, maybe not in your country. Just try it out. You have a link in the description below. You can clone my portfolio, have the same performance to make 20-25% per year. This is my goal, and this will be my goal for all my copiers. Almost 400 copiers that believe in my strategy. Okay, I'm one of the top 10 most copied people in France, one of the biggest accounts on the platform. And as always, if you want me to personally help you invest for yourself, I have a coaching program. So I will let you with the regular outro, and I see you tomorrow. Bye-bye. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. click the first link in the description to get more information. You will get a video, a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.